Hi there, it's Friday the 6th of September 2019. I'm Steve Towers. Welcome to ITB, and this is our first birthday show. Let's get started. Well, Bruno Le Maire, the French finance minister, has told us that he had a very constructive discussion this week with Steven Mnuchin, the US Treasury Secretary, in regard to the Trump-Macron deal on France's digital services tax. But he revealed nothing more substantive about the meeting in Washington, and neither did the Americans. So we'll just have to wait until the details are announced or leaked. Meanwhile, in Poland, it's been reported that the government has recently dropped plans for a DST. But it's full steam ahead in the Czech Republic. It's been reported that the Ministry of Finance yesterday sent to the government draft legislation for the proposed 7% digital services tax. The tax would apply to companies with global group turnover of 750 million euros and group turnover from the Czech Republic of 50 million Czech koruna, which is about 2.1 million US dollars. The DST would start from mid-2020. Stock markets greeted the news yesterday that high-level trade talks between China and the US will resume in Washington in October, to be attended by China's top trade negotiator. And according to a Chinese government statement, serious mid-level discussions to prepare for the October talks will commence in mid-September. And showing perfect timing, the Congressional Research Service, an agency of the US Congress, has released an updated version of its report on US-China relations. For a copy of the report, please go to our website or app. The OECD has released a report on the second phase of the peer review of country-by-country reporting. The report covers 116 jurisdictions in the inclusive framework in 572 pages, so be careful before hitting the print button. For your copy of the report, please go to our website or app. The OECD has published the 2019 edition of its Tax Policy Reforms Report. This report provides a comparison of tax reforms implemented in all OECD member countries, plus Argentina, Indonesia, and South Africa. For a copy of the report, please go to our website or app. And now for the bad news. The IT system of the Bulgarian tax authorities was hacked, and a significant amount of its data was provided to the media in July. And that included data automatically exchanged with other countries under the OECD's Common Reporting Standard and the EU's Directive on Administrative Cooperation. For a copy of the OECD statement on this topic, please go to our website or app. The Australian Federal Court has decided an interesting transfer pricing case concerning Glencore. The court's decision emphasises the point that, other than in exceptional circumstances, the OECD's transfer pricing rules require the actual transaction which was entered into between the parties to be priced. Absent those exceptional circumstances, the actual transaction cannot be reconstructed into a completely different hypothetical transaction. As you would expect, the court in Glencore was therefore required to examine the 2017 decision of the full federal court in the Chevron case. Let me give you a recap of the Chevron case. Here are the facts. The Chevron case concerns the interest rate which was charged on a loan from a US company to an Australian company, both being members of the Chevron Group. In fact, as you can see, the lender, USCo, is a subsidiary of the borrower, AustCo. The amount of the loan was the Australian dollar equivalent of 2.5 billion US dollars. So to be clear, the loan was denominated in Australian dollars. The term of the loan was 5 years, with provision for early repayment at the borrower's option. The interest was payable monthly at a rate equal to 1 month Australian dollar LIBOR plus 4.14%, 414 basis points per annum. And the loan was unsecured. The loan agreement did not contain any financial or operational covenants, and the loan was not guaranteed by the ultimate parent or any other company within the group. The Australian tax authorities took the view that the interest rate was excessive under the arm's length principle, and thus they denied a deduction for a large part of the interest under Australia's transfer pricing rules. The taxpayers' key argument was that the transfer pricing rules should be applied to price the interest rate on the actual loan made between the two parties. There should be no reconstruction of that actual loan. That actual loan was unsecured, it had no covenants, and it was not subject to any guarantee. According to the taxpayer, if the interest rate on the actual loan were priced according to the arm's length principle, the actual interest rate would not be seen to be excessive. It would be no higher than the arm's length interest rate for such a loan, which is unsecured, has no covenants, and is not guaranteed. The 3 judges in the full federal court disagreed with that approach. There are 2 particular points in the court's 2 main judgments. The first point is that the court did not view the lack of security, covenants, and guarantee as essential elements of the actual loan, with only the interest rate to be determined under the arm's length principle. Instead, the court viewed the actual loan as the mere lending of the Australian dollar equivalent of 2.5 billion US dollars for 5 years, with the arm's length consideration including not just the interest rate, but also the other elements of the loan, such as security, covenants, and guarantee. In other words, by defining the actual loan in such a narrow way, the court viewed the arm's length consideration as covering key elements of the loan beyond the mere interest rate. And the second point to note is that the court took the view that the arm's length principle merely requires an assumption that the borrower and the lender are dealing at arm's length. It does not require the borrower, AustCo in this case, to be assumed to be a standalone or orphan company. For example, Chief Justice Alsop said this: "There is no reason derived from the language of Australia's transfer pricing rules why the hypothesis based on independence should, of necessity, do other than assess what the taxpayer or a person in the position of the taxpayer would be expected to give by way of consideration in respect of the relevant transaction to a party independent from it. The independence hypothesis does not necessarily require the detachment of the taxpayer as one of the independent parties from the group it inhabits, or the elimination of all the commercial and financial attributes of the taxpayer being part of the circumstances that gave the commercial shape to the transaction, and that may be relevant to the consideration for the transaction. The court then asked this question: if we apply the arm's length principle to the borrowing by OSCO, but in the context where OSCO is a member of the Chevron Group, what would we reasonably expect to happen? The court provided this answer: we would expect the loan to be subject to a parent guarantee. Justice Pagoni said this: it is not to the point that OSCO, if it were a standalone company, had a risk rating on a scale approximately equal to BB plus loans. It can be accepted that its credit profile was critical to the pricing of loans available in the market in question, but the credit profile of the hypothetical OSCO is not the inquiry required by the transfer pricing rules. The inquiry was not to determine the price of a loan which OSCO obtained from USCO, nor to price a loan like that loan which OSCO, with its credit worthiness, might have been able to obtain as an independent arm's length party to such a loan, but to make a prediction about what might reasonably be expected to be given or agreed to be given under a hypothetical agreement if the parties had been independent and were dealing at arm's length in relation to the transaction. The evidence before and found by the judge at first instance amply supported his prediction of the reasonable expectation of a borrowing by OSCO being supported by security. The policies of Chevron were that no external financing could take place unless the ultimate parent approved of the borrowing. An objective of the group was to obtain the lowest cost of funding to the group for external borrowing, and that objective was generally achieved by providing a parent guarantee. The full federal court's reasonable prediction approach, which allowed a parent guarantee to be included in the hypothetical arm's length loan, has caused commentators to state that the court effectively applied a reconstruction of the transaction. Let me summarise the facts in the Glencore case. Swissco and ACO are members of the Glencore Global Group, with Swissco being the direct parent of ACO. ACO is an Australian resident company which conducts a copper mining business in Australia. ACO sells copper concentrate to Swissco under offtake agreements. Since recommencement of ACO's copper mining operations in 1999, those offtake agreements were structured as so-called market-related agreements. In 2007, the two companies entered into a fundamentally different type of agreement, a so-called price-sharing agreement. Under the price-sharing agreement, the first step in determining the price was by using as a reference point the official London Metal Exchange cash settlement price for copper grade A averaged over the quotational period. This average price is called the copper reference price. The quotational period was, at Swissco's option, linked either to the month of shipment or the month of arrival of the copper concentrate. And then, within each of those two alternatives, Swissco had the option to declare one of three quotational periods to be declared prior to each shipment from the loading port, at which point Swissco would be aware of the average copper prices in at least one of the periods from which it was to make its selection. This aspect is known in the industry as quotational period optionality with back pricing. And in the second step, a deduction was made from the copper reference price for treatment and copper refining charges. During the relevant years, this deduction was set at 23% of the copper reference price. And so the price for the sale of the copper concentrate was 77% of the copper reference price. The Australian tax authorities made two sets of transfer pricing adjustments. Firstly, adjustments to remove the effect of the 23% deduction for treatment and copper refining charges and replace it with the rate previously used under the market-related agreements. And secondly, adjustments to reflect the impact of a consistently applied quotational period. Justice Davies said this: "The adjustments made by the Commissioner reflect the Commissioner's primary case that the February 2007 agreement was a non-arm's length dealing which favoured Swissco to the detriment of ACO, and that an independent mine producer with ACO's characteristics would not have agreed to price sharing at all, or to quotational periods with back pricing optionality, and instead might reasonably have been expected to have sold its production in the relevant years under a life of mine agreement on market-related terms and limited quotational period optionality with no back pricing." In other words, a reconstruction of the contract. In regard to ACO's position, Justice Davies said this: "The taxpayer's primary case was that, unlike in Chevron, where the terms of the loan diverged from terms which might be expected between independent parties dealing at arm's length with each other, the terms governing pricing under the contractual arrangements which applied to the relevant years were terms that existed in contracts for the sale of copper concentrate between independent market participants, and were thus terms that might be expected to be found in an agreement between the relevant hypothetical parties." One other point to note is that the respective TP adjustments in both the Chevron case and the Glencore case relate to years when the 1995 version of the OECD transfer pricing guidelines was applicable. In those 1995 guidelines, there are two exceptional situations where a reconstruction of the transaction can be appropriate. Firstly, where the economic substance of the transaction differs from its form. And secondly, where the arrangements made in relation to the transaction, viewed in their totality, differ from those which would have been adopted by independent enterprises behaving in a commercially rational manner, and the actual structure practically impedes the tax administration from determining an appropriate transfer price. The court addressed two main issues. The first was whether the tax authorities' attempted reconstruction of the transaction was valid. The court's conclusion was no. Justice Davies said this: "I accept the taxpayer's submission that reconstruction was not appropriate. In my opinion, the Commissioner's approach impermissibly restructures the actual contract entered into by the parties into a contract of a different character. The decisions in Chevron, both at first instance and on appeal, make it clear that the hypothetical should be based on the form of the actual transaction entered into between the associated enterprises, but on the assumption that the parties are independent and dealing at arm's length, in order to identify a reliable substitute arm's length consideration for the actual consideration given or received. This is consistent with the 1995 OECD transfer pricing guidelines. The present case is not a case falling within either of the exceptions referred to in the 1995 guidelines. To the contrary, the February 2007 agreement was a form of agreement seen in the market between independent enterprises in the relevant years, and the price-sharing methodology adopted by the parties under that agreement was a recognised, legitimate and accepted way for copper concentrate to be priced, and one which other market participants, independent of each other and dealing at arm's length, also adopted at the time in respect of the supply of concentrate by a mine producer to a trader. The second issue addressed by the court, on the basis that the contract would not be reconstructed, was whether two key aspects of the price formula in the contract were consistent with the arm's length principle. Those two key aspects were, firstly, the 23% deduction, and secondly, the absence of a discount as a quid pro quo for the quotational period optionality conferred on Swissco. The court concluded that, based on the evidence, both aspects complied with the arm's length principle. And so the taxpayer won the case, which I think is obviously the right answer, in view of the fact that the type of contract and the key aspects of the price formula were present in third-party transactions in the copper concentrate industry at the relevant time. But it is interesting to wonder about the reconstruction argument and the court's re-examination of the Chevron decision. Based on Justice Davies' decision, reconstruction of contracts would be a relatively rare event. That was not the expectation of the Australian tax authorities after the full federal court decision in the Chevron case was delivered. For that reason, even though this might not be the ideal case for reconstruction, I would expect the tax authorities to appeal this Glencore decision to the full federal court. For a copy of this Glencore decision and also a copy of the full federal court decision in Chevron, please go to our website or app. In Australia, the tax authorities have released for public comment draft guidance in regard to the GST treatment of what's called anything other than goods or real property. The draft guidance therefore applies, for example, to transactions involving services, including digital services and financial services, and intangibles. The focus is on the connectivity with Australia, and so the examples in the draft guidance generally have a cross-border aspect. Public comments are requested by the 16th of October. For a copy of the draft guidance, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided a case in regard to the beneficial ownership condition in Article 11, the interest article in the 1994 India-Cyprus Treaty. As you might know, that 1994 treaty was terminated and replaced by a new treaty in 2017. The facts in this case relate to the 2013-14 assessment year, and so the 1994 treaty was applicable. Here's the relevant structure. A Mauritius company owned 100% of the shares in a Cyprus company, and it also owned 99.5% of the shares in an Indian company. The Mauritius company provided significant finance to the Cyprus company in the form of an interest-free loan which was denominated in US dollars. From that financing, and shortly after the financing was received, the Cyprus company made an interest-bearing loan to the Indian company. This interest-bearing loan was denominated in Indian rupees. The Cyprus company had no business activities other than the loan to the Indian company. Also, it had no employees or office premises. An institutional service provider performed corporate secretarial and management functions for the Cyprus company. However, the Cyprus company did have a tax residency certificate issued by the Cyprus tax authorities. The Indian tax authorities claimed that the Cyprus company did not satisfy the beneficial ownership condition in Article 11.2 of the treaty, and therefore the Cyprus company was not entitled to the rate limit of 10% on Indian tax on the interest. To support the claim, the tax authorities pointed to the back-to-back nature of the two loans and the lack of substance of the Cyprus company. The tribunal rejected that claim. It pointed to the 2017 OECD commentary on Article 11, which says in part, where the recipient of interest does have the right to use and enjoy the interest unconstrained by a contractual or legal obligation to pass on the payment received to another person, the recipient is the beneficial owner of that interest. The tribunal said that the tax authorities had given no evidence that the Cyprus company did not have the exclusive possession and control over the interest income received, or was not free to utilise the interest income received at its sole and absolute discretion, unconstrained by any contractual, legal, or economic arrangements with any other party. And in the absence of such evidence, the Cyprus company must be regarded as the beneficial owner. Let me make a couple of points. Firstly, there are two aspects of the facts which would make it unlikely that the Cyprus company would fail the beneficial ownership condition on the basis that it was a conduit company. The loan from the Mauritius company was interest-free, and therefore there should be no interest payments by the Cyprus company. And there is a currency switch. The loan from the Mauritius company is in US dollars, while the loan to the Indian company is in Indian rupees. Both of these aspects make the structure quite different from classic conduit company cases such as Indofood. Secondly, it's interesting that the tribunal applied the 2017 commentary, even though the treaty was signed in 1994, an ambulatory view of the commentary. For a copy of this case, please go to our website or app. In Indonesia, the government has issued a regulation which exempts the upstream oil and gas sector from various taxes. For a copy of the regulation, please go to our website or app. Also in Indonesia, the finance minister this week announced a number of tax reforms aimed at attracting more foreign investment. The two most important changes concern corporate income tax rates. Firstly, the current corporate income tax rate of 25% will be gradually reduced to 20% starting in 2021. If this tax reduction sounds familiar, it's because this idea has been publicly discussed by the President and government officials over the last few months. And secondly, the corporate income tax rate will be reduced to 17% in the first 5 years following a company's IPO. In Malaysia, the tax authorities have issued guidance on the imposition of service tax on inbound digital services. For a copy of the guidance, please go to our website or app. The European Court of Justice has decided a case in regard to the VAT treatment of the sale of land on which a building is constructed. For a copy of this case, please go to our website or app. The EU's VAT committee has published the minutes of its most recent meeting, at which quick fixes were discussed. For a copy of the document, please go to our website or app. And the European Commission has released its latest report on the size of the so-called Vat Gap in the EU, the overall difference between the expected VAT revenue and the amount actually collected. The latest report is for the 2017 year. The good news is that the size of the VAT gap reduced by 8 billion euros compared with the previous year. The bad news is that it's still too high, 137.5 billion euros. For a copy of the report and the Commission's press release on this topic, please go to our website or app. In France, the tax authorities have issued guidance in regard to the subject to tax condition, which applies to interest paid to related companies. The guidance considers the situation where the interest is paid to a related Belgian company, which benefits from a notional interest deduction available under Belgian law. The guidance indicates that the notional interest deduction is not taken into account when assessing compliance with the subject to tax condition. For a copy of this guidance, please go to our website or app. In Ireland, the government has released a feedback statement in regard to the public consultation on the country's transfer pricing rules. The feedback statement includes examples of possible legislative provisions. The government has invited public comments on this feedback statement, but the deadline is close. It's next Friday. Yes, that's right, Friday the 13th. For a copy of the feedback statement, please go to our website or app. In Romania, the government is planning to launch a pilot of the Standard Audit File for Tax, SAFTI, for large taxpayers in January 2020. SAFTI is already operational in 9 European countries, generally on a voluntary basis, although it is mandatory in Poland. In Sweden, the government has announced that a bank tax will be introduced to be effective in 2022. The stated purpose of the bank tax is to raise 5 billion Swedish krona, which is about 500 million US dollars, each year to finance an increase in defence spending. The government is concerned about Swedish security in regard to Russia. No details of the bank tax have been released. In Switzerland, the Federal Supreme Court has decided a case in regard to VAT-exempt intermediary services. The court decided that a person does not need to have a proxy, a power of attorney to act for and on behalf of a client in order for that person's services to the client to qualify as VAT-exempt intermediary services. For a copy of this case, please go to our website or app. In Mauritius, the government has issued regulations in respect of 3 matters. Firstly, the substance requirements in regard to the partial exemption regime. Secondly, the computation of a CFC's income for the purposes of the newly introduced CFC rules. And thirdly, substance requirements for a Freeport operator or developer to enjoy the 3% corporate income tax rate. For a copy of the regulations, please go to our website or app. In Tunisia, the tax authorities have issued guidance on the application of the deduction for reinvestment in the share capital of hotel businesses. For a copy of the guidance, please go to our website or app. In Bahrain, the tax authorities have issued 2 items of guidance in regard to VAT. The first is an updated version of the guidance on the VAT treatment of real estate, and the second is an updated version of guidance on VAT registration. For a copy of both of these items, please go to our website or app. In Argentina, the government has imposed currency controls on companies and individuals. The currency controls will apply from the 1st of September 2019 to the 31st of December 2019. The currency controls have been introduced via 2 documents: a decree issued by the executive branch and a communication issued by the central bank. For a copy of both of these documents, please go to our website or app. In the US, another development in the taxpayers' petition for an en banc rehearing in the Altera case. The government has now filed a response in opposition to the taxpayers' petition. For a copy of the government's response, please go to our website or app. Also in the US, the IRS has issued Revenue Procedure 2019-36, which provides guidance for foreign insurance companies in regard to Section 842B of the Internal Revenue Code. For a copy of this document, please go to our website or app. And now for this week's treaty developments. We've had 1 treaty signed and 3 protocols enter into force. I have 2 articles for you this week. The first article is called Carpet Bombing Tax Avoidance in Europe, examining the validity of the ATAD under EU law. It's written by Ivan Lazarov and Siram Govind, and it's published in Kluwer's Intertax Journal. The article starts with this useful synopsis. This article examines the compatibility of the Anti-Tax Avoidance Directive, ATAD, with primary EU law on 4 grounds. First, it argues that the directive is incompatible with the general principle of anti-abuse developed by the European Court of Justice. Second, it considers the directive to not comply with the requirements of Article 115 of the Treaty on the Functioning of the European Union, as it does not contribute to the establishment and functioning of the internal market per accepted case law of the ECJ. Third, the directive is at odds with the principle of subsidiarity, as the Commission put forward no convincing evidence regarding the need for such a directive at an EU level. Finally, several provisions of the directive go beyond what is necessary to combat artificial arrangements in a tailor-made fashion, thereby making it incompatible with the principle of proportionality. The authors conclude in this way. The authors wholly agree that cross-border avoidance of taxation in the EU is definitely a problem that requires coordinated action among member states, justifying EU-level action. The authors also acknowledge that the prevention of abuse is a general principle of EU law that must be respected by all taxpayers within the EU. However, the authors believe that an EU-level instrument dealing with anti-avoidance must be focused enough to only remove obstacles within the EU created by anti-avoidance, and it must only constitute necessary action in this respect. The ATAD fails on both these grounds, and in the opinion of the authors, goes beyond the powers granted to the EU to legislate in the area of anti-avoidance. The second article is called Going the Way of the Polaroid, Digital Taxation and the End of the Arm's Length Principle. It's written by Christian Kaiser, Jeffrey Owens and Sam Sim, and it's published in Tax Notes Today International. An important point to note is the question mark in the title of this article. The authors conclude that the current discussion of digital taxation is not the end of the arm's length principle. Instead, they argue that the various formula-based proposals which are under consideration in Pillar 1 of the Digitalisation Programme of Work are merely pragmatic adaptations to the arm's length principle, similar to other pragmatic adaptations which have characterised the evolution of the arm's length principle over many years. The authors write this: "The secret to the longevity of the arm's length concept lies in the fact that it is flexible while also being principle-based." The authors then give several examples of flexibility in the past. The introduction of profit-based methods as a response to the difficulty in obtaining comparables. The so-called authorised OECD approach in regard to the attribution of profits to PEs, and the allowance of safe harbours. The authors then write, "With those adaptations, one might argue that at no time did the OECD transfer pricing guidelines ever reflect a pure application of the arm's length principle. Exceptions and compromises abound, as is expected of any consensus document that must inform the application of a pure principle with a realistic understanding of how it can be applied with reasonable certainty and administrability for a diverse group of countries." The authors conclude in this way: "None of the proposals to use partial or quasi-formulary apportionment to tax the digital economy reject the arm's length principle. On the contrary, the proposals should be properly understood as limited modifications designed to attribute more profits to users, user participation, and market countries. At best, they are limited and partial, not global, suggestions that can be seen as pragmatic, administrable approaches to specific concerns, whether for PEs or digital business models, for which the arm's length principle had proven inadequate. No one is questioning the new functional analysis approach based on an accurate delineation of transactions as established by BEPS Actions 8 to 10, nor suggesting large-scale revisions to the 2017 OECD transfer pricing guidelines." Well, that's the way it is this Friday, the 6th of September 2019. I'm Steve Towers. Have a great weekend.